What I will be discussing in this video is the contemporary approach in financial analysis. So we have financial ratios, and it's called ratios because you will be coming up with a fraction, no? Which you will convert to a decimal, and then from decimal to percentage. And then in this fraction, you will be using amounts from your statements, no? And of course, these statements, when you get their amounts, no, they will have the same units. So they will be carrying peso sign. Your numerator is peso, your denominator is peso, giving you a ratio. Because if your numerator is, for example, meter, and then your denominator is second, you have there different units, no, in your numerator and denominator, and that is called a rate, no, in mathematics. If it is different, it's rate. If it's the same, numerator, denominator, that's ratio. So here it's called ratio because you will just be pulling out amounts from your statements, and they are in peso, no, that's the unit. Financial ratio is classified into three. Number one, we have your liquidity ratios. Liquidity. Next, we have the solvency ratios. And then finally, we have the profitability ratios. So just to explain these three briefly, when we say liquidity ratios, you are dealing with, or you are trying to determine the capability of the company to settle short-term obligations. If you want to learn more about the short-term obligations of the company, you may want to refer to the company's liquidity ratios. For solvency, you are now dealing with long-term obligations. Okay, so if you are interested with the long-term obligations, go ahead and look at the company's solvency ratios. And for profitability, it's in the name itself actually. So if you want to learn more about the profitability of the company, the capability of the company to earn revenue, you refer to the profitability ratios. First, I will talk about the liquidity ratios. And I'm telling you right now that this is just formula, no? But let me just present it differently, no? So that it will be an easy extract for you whenever you are tasked to compute for these ratios. Get your cash, and then add your marketable securities, and then add your trade receivables. These three actually comprise your quick assets. How come they are labeled as quick assets? Because they can be converted to cash easily. Cash is quick because it's cash right away. Marketable securities can be converted to cash easily, as well as your trade receivables, no? That's why these three are classified as quick assets. And then after your quick assets, you will add your other current assets to get your total current assets, correct? So what I place here is something that you already know. I just introduce another concept, quick asset. So after writing this down, get your quick assets and this one, and divide it by your current liability. I will also do the same with current assets. Total current assets divided by current liability. And then, aside from that, I will get again my total current asset and deduct current liability. Because from these three, we can get the first three ratios. So if you get your quick assets and divide it by your current liability, you will get your quick ratio. And this one is also called acid test ratio. Acid test ratio. Okay, so this is one. If you get your total current asset divided by total current liability, you will get your current ratio. Okay, so this is the second. And then finally, although this is not really a ratio because you are deducting, no, you don't have a fraction here, but books classify them under liquidity. So total current assets minus total current liability, this is called working capital. And this is the third. But I'm telling you right now that more important than the formula is to be able to interpret. Working capital, it basically tells you if your current assets are higher than your current liabilities. So for working capital, you want it to be positive. so that the company would be able to settle their current liabilities. But the problem with working capital is that it doesn't allow for comparison because you just have the value. And a value may be high to some companies but minimal to some companies. That's why it's hard to compare with just your working capital. So better than the working capital is your current ratio because you have the percentage and you can now compare. But the problem with current ratio is that since you are using all current assets, including current assets that are not quick, the other current assets here will include your prepaid assets. And of course, prepaid assets, you don't expect to be getting money from that, right? And then your inventory. Of course, for inventory, it will take a while before you can sell them. So even though if your current ratio is good, considering that you have more current assets that are not quick, it may imply that the company may not be able to settle the obligation. So better than the current ratio is the quick ratio, because what you do here is you get your quick assets, meaning assets that can really pay off your obligation, and then you divide it by current liability. So in terms of ranking, working capital is not really that good. Current ratio is okay, but if you can compute for the quick ratio or the acid test ratio, that would be the best, because you can really tell whether the company can settle the obligation because you are using your quick asset as part of your computation, not your total current assets. Because again, if you use your total current assets, that will include your current assets that may not be converted to cash anymore, or it takes a while before they can be converted to cash. So we have the 3 as part of our liquidity ratios. Let's have another. Let me just write this formula here. Net sales minus cost of sales equals gross profit, right? I'll end it there. Get your net sales and divide this by your average accounts receivable. And then also get your cost of sales and divide this by your average inventory. So if you do this, the first one, net sales divided by average accounts receivable, this is called accounts receivable turnover. Next, if you get your cost of sales and divide it by your average inventory, you will get your inventory turnover. So again, more important than the formula is to be able to interpret this. So I'll start with AR turnover. You need to write this down. AR turnover will tell you how many times you were able to convert your accounts receivable to cash per year. So I'll repeat. This tells you how many times you were able to convert your accounts receivable to cash in a year. That's the accounts receivable turnover. While for inventory turnover, this tells you how many times were you able to convert your inventory to accounts receivable or sales in a year. That's inventory turnover. You may be wondering, what's with this average? What do you mean by average here? How do we compute that? How do we get that? So I will just assume a data here. Let's say you have your current assets here and you have your AR and then your inventory. Then you have 2-year data. 2020, then 2019. Let me just assume some figures here. 190. Let's say ganyan. So now, if you are asked, what is the average AR in 2019, same with 2020, and then average inventory in 2019, and then also 2020. Let's start with 2019. If you are given like this, you only have 2 data, you will assume that the company started in 2019 because you don't have data prior. So what's your average inventory? Since you are only given 1 year, of course you don't have 2020 yet because you are in 2019. So you are in 2019, you only have the 2019 data, so you have nothing to average. So your formula here is your AR, since you only have that one as your AR, you divide it by 1, so you get 90. This is the average for 2019. How about for 2020? Since you have the data, no, for 2020 already, you can average. So 100 plus 90 all over 2. Answer is 95. So this is the average AR in 2020. Next, average inventory. So this is 70 divided by 1, 70. Next, 70 plus 80 divided by 2. So 150 divided by 2, it's 75. So this is how we get the average. What if we are given 3 years? Let me just explain that as well. So AR again, inventory, 2020, 2019, and then 2018. Assume some figures here. So what is the average AR in 2018, 2019, 2020? Average inventory in 2018, 2019, 2020. For 2018, it's the same. Again, if you are in 2018, you don't have the data yet for 2019 and 2020. So this is 80. Next, for 2019, you have 2-year data. 90 plus 80 divided by 2. So this is 85. How about for 2020? For 2020, you will only refer to 2 years. You cannot average everything that you have. You can only average 2-year data. So in this case, what you will do is just get the average of 2019 and 2020. So 100 plus 90 divided by 2, 95. This is how you do it. You will not add everything and then divide it by 3. It's not correct, okay? So again, if you are given 3-year information and you are asked to get the average of the current year, you only use the current year and the previous year as the numerator. You don't add everything. So for inventory, it's easy. Just copy 50 and then 50 plus 60 divided by 2, 65. This is 55. Next, so 70 plus 60 divided by 2, this is 65. So this is how you compute the average. Of course, for the net sales, cost of sales, whatever you have in your income statement. So before I jump to the next ratio, let me just give you a tip, no? Because there is a problem here. After I give you all the formulas, it may be confusing to some. Sir, when do we need to do averaging? Do we do it every time? So can we have like a clue on how to determine whether we average a specific account title or not? I'll just write tip. So my tip for this one is this. You will look for a ratio with 1 account title from income statement and 1 account title from balance sheet. So if you have a ratio where the amounts are sourced from different statements, that's the time when you need to average. For example, this one, net sales is from the income statement, right? And then AR is from the balance sheet. That's the signal that you need to average. What? Only average those found in the balance sheet. Balance sheet account titles. That's the tip. So again, you will only do averaging if you have a ratio where the account title is sourced from both income statement and balance sheet. But you will not be averaging the income statement element but the balance sheet element. So for example, in this case, net sales is from the income statement. You don't average that. You get the amount. While for the accounts receivable, you will be averaging because this is from the balance sheet. Please take note of this one. This is just a guide, no, to tell you that you need to average because this is normally where the students get it wrong. They don't know when to average. So you have to take note of this one, okay? So I'll go back. So this is formula 4 and this is formula 5. So that's number 4 and number 5. For the next formula, you will get 360 or 365 depending on the problem. But the first priority here is the given, no? Whatever you are given. If it says 360, you use 360. If it says 365, you use 365. What if it is silent, meaning there is no mention? You use 360. After that one, you will divide your answer earlier. Divide your accounts receivable turnover as well as your inventory turnover to get another liquidity ratio. So if you get the days, 360 or 365 depending on the given, again, if it is silent, you use 360. Let's say it's silent, 360 divided by your accounts receivable turnover to get another financial ratio, and this one is called the average collection period. And then, if you do the same, 360 divided by inventory turnover, you will get your average inventory period. So this is the formula. This is formula number 6, and this one is 7. Again, more important, the formula is the interpretation. Average collection period, write this down. Average collection period tells you the number of days it will take you to convert your accounts receivable to cash. Again, average collection period tells you the number of days will it take you to convert your accounts receivable to cash. How about average inventory period? Average inventory period tells you how many days will it take you to convert your inventory into AR or sales. Again, average inventory period tells you how many days will it take you to convert your inventory to sales or accounts receivable. So you have your average collection period and then your average inventory period. And if you add these two, yan, this one and this one, you will get the operating cycle. So this is number 8 already, right? Kasi in average collection period, this is the number of days before you can convert your AR to cash, right? And this one is from inventory to AR. So you are just adding. Okay, parang ganyan. So operating cycle now tells you how long will it take you to convert your inventory to cash. I hope you get the logic, no? Again, this is number of days. The collection period, inventory period, number of days, turnover, how many times. If you try to think of the formula, there is a logic, right? Why we are getting 360 and you divide your turnover. And that's it for your liquidity ratios. So I think I will stop now because this is long already. So I will come up with another upload for the next classification, your solvency and profitability. This should have been quick, but I discussed averaging. Also, I gave you these tips. So it took me a while to discuss. So in the next upload, I will be discussing solvency and then profitability. Okay, so see you on that one.